feel like you're running on a treadmill while everyone else is taking the elevator, you're not crazy. You're not lazy. You're not bad with money. You're just being left behind. And it's not by accident, it's by design of how the modern economy works now. 10 years ago, you could buy a decent home for $300,000 and you could refinance at 3% and you can build equity quickly. Today, that same house is pushing $600,000 to $800,000 in many markets. Interest rates have doubled, insurance costs have surged, property taxes increased, wages didn't triple. So what happened? In this video, we're breaking down why the middle class is shrinking, why asset owners are accelerating ahead, and why traditional advice no longer works. And most importantly, how you escape. Because if you don't understand this shift, you'll blame yourself. And this isn't about blame, it's about awareness. Let's do real numbers. In 2016, median home prices were $300,000. Interest rates were around 3.5%. Your monthly principal and interest payment was around $1,350. Fast forward to 2026, the median home price, $420,000 to $450,000 nationally. Interest rate, 6.5 to 7%. But just as of recently, we have hovered down below the 6% range, but let's just go off of this case scenario still. Monthly payment, over $2,700 in many cases. That's double, but median household income didn't double. Housing is no longer 3 times income. In many markets, it's 6 to 7 times and even 8 times the income. That changes everything. The middle class used to build wealth through home equity, wage growth, and now both are harder to access. And here's what makes it worse. If you bought before 2020, you locked in on low rates. And if you didn't, you're stuck renting from someone else who did. Here's the shift that nobody talks about. We don't live in a wage-driven economy anymore. We live in an asset-driven economy. If you own real estate, stocks, businesses, crypto, equity, from 2010 to 2022, your net worth exploded. And if it didn't, your expenses exploded. The gap widens. This is called asset inflation. When money is printed, when interest rates drop, when stimulus flows, assets inflate. Owners benefit, but non-owners fall behind. And this is the new divide, not rich versus poor, it's owners versus workers. Now, before you think this is doom and gloom, I'm gonna show you how to play this game. But first, you need to see how deep the shift goes. Here's what keeps the middle class looking okay on the outside. Debt. 84-month car loans, buy now, pay laters, credit cards, HELOCs. You can finance a lifestyle your income doesn't support. So it feels like you're in the middle class. Nice car, nice apartment, nice vacation, but behind the scenes, negative cash flow, no asset ownership, minimal investing, and debt does something dangerous. It steals future investing power. Every dollar in interest is a dollar not compounding. The wealthy uses leverage to buy assets. The middle class uses leverage to buy liabilities. That's the difference. Let's talk housing supply. Starter homes used to exist. Today, builders focus on high margin properties. Zoning restrict density, investor buy entry-level inventory, short-term rentals reducing supply. The $200,000 to $300,000 entry point is disappearing, which means first-time homebuyers are struggling, which means wealth accumulation gets delayed. And time is everything in compounding. If you start investing at 25 versus 35, the difference can be hundreds of thousands of dollars, and delays really matter. Go to college, get a stable job, save 10%, retire at 65. That advice was built in a different era when homes were affordable, pensions existed, healthcare costs were lower, tuition was manageable. Today, student loans eat income, healthcare drains savings, housing requires huge down payments. The middle class formula assumed predictable inflation, but we just experienced asset hyperinflation. Different game, same old advice. And that's why it feels harder, because it is harder. Let's be real, nobody sat in a room and said, let's destroy the middle class, but incentives matter. Low interest rates benefited asset owners, corporations can easily access cheap capital, institutions buying neighborhoods in cash, and policies inflate financial markets first. The wealthy have access to better financing, better information, better tax strategy, equity ownership, and the middle class has access to W-2 income, taxed first, pay last. That structure compounds. Now, here's the most important part. You don't fix this by complaining, you fix it by adjusting. You must become an owner. That can mean index funds, rental property, house hacking, business equity, digital income streams, and skill stacking for higher income. When I started buying rentals, it wasn't because I love toilets, it was because rent rises with inflation. My fixed mortgage stays fixed. That spread builds wealth. When I started YouTube, it wasn't about fame, it was about leverage. One video, many viewers, and hopefully recurring income with your guys' support. And speaking of that, if you're enjoying this video, please hit that like button and as well consider subscribing so you get notified anytime we drop more videos. And for you doing that, here's a cute picture of my pups. Here's the mental pivot. Stop asking, how do I survive? And start asking, how do I own? Even small ownership matters. $100 invested monthly, side income reinvested, equity participation, because the gap between asset owners and non-owners will likely widen. And if you don't want to wake up 10 years from now and realizing you were working hard in the wrong game, then you want to get started now.